This is Robert C. Baker, and this is Robert on Real Estate. Let me say this right out of the chute. Understanding economic forces is important in understanding real estate. Why? Well, first, because real estate is an asset, although a very special kind of asset. And second, because for most Americans, real estate is the primary asset. And third, because real estate is impacted by inflation and interest rates. The hot topic recently has been, of course, inflation. On May the 7th, the U.S. Department of Labor Statistics announced that only 266,000 non-farm payroll jobs had been created. And with that news, some economists began predicting that we would see a cool down in inflation. Those disappointing figures left us with a 6.1% unemployment rate in April, which was little change from the month previous. And then came two main predictors of inflation, the Consumer Price Index and the Producer Price Index, which were released May 12 and 13, respectively. And these reports dashed hopes, at least for now, that the rising prices we're seeing, say for lumber, steel, used cars, gasoline, and food, were only temporary. For now, let's take a look at some economic figures, because knowing the market is important for knowing the value and the long-term prospects of your chief asset, your home. First, the national housing market. Prices are still going up, but the number of days on market is going down.
Redfin reports that nationally homes are selling in about 18 days. Here in the greater Chattanooga area, in April, homes sold an average of 23 days. Redfin also reports that nationally home prices are up 22%. Locally, that's 20.6% when you compare April 2021 to April 2020.
Rapidly rising prices, as well as the speed at which homes are selling currently, are of course fueled by low interest rates and low inventory. But people are beginning to notice a trend.
Freddie Mac, a government-sponsored entity buying loans on the secondary market, reports a 30-year mortgage interest rate of 2.94%. But note what they also say. This may not last long as consumer inflation has accelerated at its fastest pace in more than 12 years and may lead to higher mortgage rates in the summer.
Not next year, but this summer, they say. For its part, the U.S. Federal Reserve is keeping interest rates low through open market operations, the buying and selling of securities, and the relationship it has with banks.
The 10-year Treasury is at 1.6, so we might expect a 30-year mortgage interest rate somewhere between 2.8 and 3.6. Freddie Mac's figure is just below that.
But how long can that continue? The Fed typically wants to keep inflation at about 2%, although it said earlier this year that they expected a temporary bump of inflation, say around 2.5%. But in light of the current situation, is that expectation achievable? The reason why we ask this is because, according to reliable indicators, inflation is heating up. And if inflation heats up too much, the U.S. Federal Reserve will have to raise rates, and that includes mortgage interest rates. And if mortgage interest rates rise too quickly or too high, home buyers will be discouraged. And if that happens, then we'll see a cooling of home prices. Ironically, a recent press release put out by the Mortgage Bankers Association showed that year over year, there's been an increase in mortgage applications. But we should take that with a grain of salt because remember, 2020 was all about COVID.
Note what Joel Kahn, an MBA Associate Vice President, says. Low housing inventory and accelerating home prices have started to adversely impact purchase activity.
What's not mentioned in this press release is that week over week there has been a decline in mortgage originations. If people are taking out loans, a goodly number of those loans are for more expensive or second homes. What about rising prices? This brings us to the Consumer Price Index, or CPI, which is put out by the U.S. Bureau of Labor Statistics. Basically, the CPI takes a look at the prices that you and I pay in the store or shop. Notice what's mentioned in the April report.
In the last 12 months, the All Items Index increased 4.2% before seasonal adjustment. This is the largest 12-month increase since a 4.9% increase for the period ending September 2008. Friends, that's nearly 13 years ago. Here's a helpful chart.
On the other hand, the Producer Price Index, or PPI, examines the prices that producers and manufacturers have to pay. Suffice it to say that companies tend to pass rising costs on to us, the consumer. And so the PPI gives us a look into future prices.
The PPI report notes that the demand index moved up 6.2% for the 12 months ended in April, the largest advance since 12-month data were first calculated in November 2010. Again, here's the chart.
Naturally, rising prices, and you've begun to feel them, affect consumer sentiment. If the price of a good or service rises so high, you may decide not to use or buy that good or service. The University of Michigan has a good barometer of consumer sentiment called Surveys of Consumers.
Most recent survey notes that consumer sentiment has declined. Note this, due to higher inflation. This is also reflected in how people feel about their income, which makes sense. The survey goes on to say that these forces can cause an inflationary psychology where buyers buy a lot of stuff in advance in order to avoid paying more for the same stuff in the future.
A byline from a recent Wall Street Journal article is apropos here.
Oops, the subtitle, not the byline, says, rapid increases outweighing the benefit of low mortgage interest rates. The subtitle is reflected later in the article where it says prices are rising so rapidly that they are outweighing the benefit of rock bottom borrowing rates.
In other words, despite low interest rates, home buyers will eventually tire of skyrocketing prices, multiple offer situations, and inventory they really don't like. And that's going to cool the real estate market. So where does this put you as a homeowner? Well, if you've owned your home for a while, you have developed significant equity, and should the real estate market get a little rocky, you're still in a good place. On the other hand, if you purchased your home recently and paid $10,000, $20,000, $50,000, or $100,000 over appraised value, and wish to sell your home during a buyer's market, you may be disappointed in the price. Here's a recap. Number 1, we need to keep our eye on job figures. While April's unemployment rate of 6.1% is only slightly above the traditional range of unemployment, 3 to 6%, sustained high unemployment may indicate that there are problems in the economy. Number 2, we also need to keep our eyes on prices and inflation. While the Fed has powerful tools at its disposal to influence interest rates and the economy in general, one thing it can't control is consumer sentiment. Number 3, speaking of the Fed is optimistic about our economic future, perhaps overly so. Economists and others are taking a hard look at inflation and are registering concern. Remember that your home is an asset, a special kind of asset, and that interest rates and inflation can affect the value of it. If you'd like to learn more, call or text me at 423-443-1649. This is Robert C. Baker, and this has been Robert on Real Estate.